Global alert. What's happening to the dollar and U.S. bonds? In recent months, something unexpected has begun to happen behind the scenes of the global financial system. The historic relationship between the U.S. dollar and U.S. Treasury yields, a correlation that has guided billionaires' decisions for decades, has begun to break down. But what exactly is happening? And what could this mean for the global economy and your wallet? Stay with me until the end, because you'll understand why this movement could mark the beginning of a new phase in the balance of global markets. Since April 2nd, 10-year U.S. Treasury yields have risen 27 basis points to 4.43%. At the same time, the dollar index, known as the DXY, has fallen 5.2%, approaching its lowest levels in the last 3 years. Under normal conditions, a rise in bond yields usually accompanies a rise in the dollar. This is because investors, attracted by higher interest rates, direct resources to dollar-denominated assets. But this time, the opposite is happening. Breakdown of the traditional correlation. In recent years, the relationship between the dollar and bond yields has been one of the most predictable in the market. When yields rose, the dollar also strengthened. Now, this pattern is being questioned. The positive correlation between these two forces is losing strength, and this is no accident. Several analysts point out that this break reflects deeper structural changes in the global economy, which go far beyond short-term data. The role of international trade. One of the variables that has been pushing this change is the scenario of global economic dispute. The so-called trade war between great powers, intensified by tariff barriers, protectionist industrial policies, and restructuring of supply chains, is changing the way capital flows around the world. With less predictability in trade and more volatility in international flows, investors are recalculating risks and shifting positions, often toward unconventional assets or alternative currencies. What this means for the future. This new market behavior could signal the beginning of a broader transition. The dollar, while still the world's leading reserve currency, is facing increasing diversification by central banks and institutional investors. In addition, the fiscal and monetary dynamics of the United States, with high deficits, rising debt, and geopolitical uncertainty, add layers of complexity to the scenario. All of this contributes to the fact that the dollar's strength is no longer as automatic as it once was. So we conclude that, if you've made it this far, understand that we are witnessing a historic moment. The breakdown in the correlation between the dollar and bond yields is not just a technical detail. It is a sign that the world is reconfiguring its economic foundations. And those who follow these signals closely have a real strategic advantage. Stay tuned, because we are only just beginning to see the contours of the new international financial system.